All right, so that was quite an amazing presentation, that last video. On this video here, we're going to get a little bit deeper into this fixed fractional money management feature of the spreadsheet. Barry, could you believe that we're finally at the final video?
Well, boy, I can't. We've put a lot of work into this. I can't believe we're at the last video, but you know, time flies like an arrow, TJ.
It sure does, Barry, and fruit flies like a banana.
Okay. Well, you know, TJ, at this point, we've shown an example of how it works. There's a lot more on that spreadsheet. There's some additional graphs that allow us to look at the equity curve, a graph that lets us look at the contracts that are traded, and we even have some graphs in there that talk about the loss episodes and the drawdown episodes that are real useful, so we can see at a glance just where we were taking too much risk at. So we'll want to do another run here and take a look at a little bit more information. Okay?
Yeah, Barry, one thing I noticed is that we allowed this study to cap us out at 30 contracts, but after running the study over 650 trades, we couldn't even get beyond 5 contracts, and it leads me to think that maybe we were a little bit too conservative. I mean, here's a winning percentage of nearly 70%, a real high expectancy. Let's go ahead and, let's bump it up a little. Let's push our chips in the middle. In fact, my wife's from Venezuela, and my good friend Hugo Chavez down there, the president of the OPEC producing nation, may have some use for this tool. Their country can definitely use some more revenue. If I was producing a lot of oil like Venezuela was, I think I might be interested in trading a little bit more than just 5 contracts, and I might be a little bit more risk tolerant as well. I think I would want to be able to put on at least 1% of the average daily volume, and maybe even risk up to 4% of my country's wealth.
Sure, TJ. Do you know what that average daily volume is?
I think it's probably, let's just take a rough guess, maybe 500,000 contracts a day.
Okay, that sounds good. You know, I Googled it while you were talking because
I figured you would, Barry.
I thought we should know exactly if we were going to put ourselves at risk here. So guess what? There were 573,000 contracts, average daily volume for January for light crude oil.
That's just the front month, but let's go ahead and work with that.
Okay, so let's put in here 1% of that, 5,700 contracts. Okay, we'll cap it at that because we just don't want to expose ourselves to more risk than 1% of the average daily volume on any single trade. And what was that risk factor what you wanted me to put in?
Well, I think I want to base it on the average loss instead of the standard deviation, so we'll get a little more aggressive there since our system is as robust as it is, and since I am a country and I can print money, which I pretty much do anyway, let's risk 4%.
Okay, we've got it set up. Now it'll be real interesting to see what happens on this, and as I said before, we'll go into a little bit more analysis by looking at some of the graphs to see just where we were taking on the risk and how many contracts it actually gets up to. I have no idea if it's even going to hit that cap or not, so it'll be real interesting to see. Did you get that? You got that seatbelt on?
Yeah, I sure do. And I've got an extra supply of bananas too.
Okay, well I've got my quiver full of arrows, so let's go. Here we go. Equity curve, go. Wow, TJ, look at the results of this. This blows me away.
Holy smokes.
Using those parameters, let me get my pointer to point everything out. Again, using those parameters and contract capping at 5,700 contracts, 4% risk, look at that, $161,200,000. And sure enough, it hit the cap. Hit the cap of 5,700 contracts. That's fascinating. I would think Mr. Chavez ought to invite us both down there to have some tea. I'll tell you.
Wow, that's incredible. So it actually reached a point in the trade sequence where it was putting on a 5,700 contract trade.
Sure, but I got to point out the risk we put ourselves or contract at. Notice if we move on down here under the managed contract column, we see that one drawdown episode hit a drawdown loss of $14 million. Of course, remember, as we said before, we don't know how big the contract or the account size was at that point, but we can go see here in just a second. And look at also, it was almost 40% of your account was lost in that drawdown episode before it recovered again.
That's
So
incredible.
that
So
looks
even
kind of
though
risky, but
it,
we'll have
it
to see.
even though we're only risking 4% on any trade, if you look at the single contract, it pretty much stayed almost within that parameter. But as soon as we added more contracts, couldn't peel off contracts fast enough, is what it seems to me. But still, even if you were able to handle such a risk, you did end up with a pretty nice result at the end of that
Oh yeah,
last trade.
$161 million. So let's go dig a little deeper into this analysis real quick and see just where that's. We're going to look at the graphs because we haven't shown you any of those yet. And here they are. I'm just scrolling over with the Excel scroll button. So what we're looking at here are two graphs. The top graph has the highlighter. The top graph has this single contract equity curve in blue, and that's on the left axis over here. It says single contract or single equity. And then the green graph, the green line,